When we talk about the backbone of modern computing, few names hold as much historic weight as Intel Corporation, Nasdaq, INTC. It's not just a company that makes chips, it's a symbol of the rise of personal computing, enterprise processing, and the entire digital infrastructure we rely on daily. Founded in 1968, Intel helped power the PC revolution, but in recent years, it's been on a mission to reclaim leadership in a market where competitors like AMD and Nvidia have stolen headlines. For me, Intel is one of those stocks that's hard to ignore. It's a turnaround story in progress, a deep value play in a high-tech world, and that combination always gets my attention, Starting with the fundamental metrics, Intel's earnings per share, EPS, has taken a hit in recent years due to massive capital investment and restructuring costs. As of now, EPS is sitting around $1.20 on a trailing 12-month basis, down from previous highs of over $4 per share just a few years ago. That may scare off momentum traders, but for long-term investors like me, this is where opportunity starts to shine. The price-to-earnings (PE) ratio is currently elevated due to depressed earnings, hovering above 35. But looking forward, Intel's normalized forward PE drops significantly as earnings are expected to rebound with foundry growth and new product launches. Revenue in the most recent year was around $54 billion, down from peak levels near $78 billion just a couple years ago. However, the contraction wasn't from demand loss, but mostly due to repositioning within the company. Net income is lower too, but Intel remains profitable. It still pays a dividend of about 1.5% to 2% depending on stock price, providing a small but welcome yield during this rebuild period. Let's move to financial health. This is where I begin to feel more confident as a long-term investor. Intel's debt-to-equity ratio sits around 0.4 to 0.5. Which is modest for a capital-intensive company building advanced chip foundries across the US and Europe. The current ratio is also strong, hovering near 1.8, meaning the company has nearly twice as many current assets as liabilities. They aren't cash-strapped, which is essential during a heavy investment cycle. What really excites me is free cash flow potential. Right now, free cash flow is negative due to aggressive capital expenditures, CapEx, but these investments are designed to pay off over the next 3 to 5 years. Intel is spending heavily to build its Intel Foundry Services, IFS, arm, and once these fabs come online and get loaded with customer demand, that cash flow could flip sharply into positive territory. To me, this is about laying the foundation now to win big later, Looking at growth metrics, Intel is clearly in a transitional phase. Revenue growth is currently flat or slightly negative, but that's the price of transformation. Over the next 2 to 3 years, Wall Street is expecting revenue growth to return to mid-single digits, possibly higher if IFS gains traction. Earnings growth is similarly positioned for a rebound. Once CapEx stabilizes and margins normalize, EPS growth could bounce strongly. The market cap is around $130 billion, a steep drop from previous highs, but that only adds to the upside for value-focused investors. Intel is still one of the largest semiconductor companies in the world by revenue. It's not going anywhere, and it's investing heavily to ensure that the next 10 years look different than the last 5. That's the kind of pivot I'm drawn to, On to valuation metrics. Intel's price-to-book (PB) ratio is around 1.3, which is low by tech standards. That tells me the market isn't giving much premium to its assets or future earnings potential right now. That's a classic deep value setup. The PEG ratio, price/earnings to growth, isn't particularly useful in the short term due to suppressed earnings, but on a forward basis, it looks more attractive as growth rebounds. What matters to me here is that Intel is trading at near tangible book value while owning world-class fabrication assets, engineering talent, and contracts with defense and commercial customers alike. You're paying almost nothing for growth right now, which makes this a potentially asymmetric bet for patient investors, Now, looking at performance metrics. Intel's beta is around 0.9 to 1.0, so it generally moves with the market. The 52-week high/low range has been wide, with lows around $25 and highs above $45 recently. That kind of volatility reflects investor uncertainty around the turnaround timeline. But it also creates opportunity. Buying closer to the lows has historically rewarded those willing to wait. This isn't a quick trade. This is a multi-year restructuring play where entry points matter. Personally, I've been watching these dips to accumulate slowly, Let's talk strategy and execution, because this is where the Intel story gets more interesting. Under CEO Pat Gelsinger, Intel has pivoted hard back to innovation and manufacturing. They're doubling down on in-house chip production, building fabs in Arizona, Ohio, and Germany. They're also aggressively pursuing foundry customers to rival Taiwan Semiconductor, TSMC. This vertical integration model is bold, and if it works, Intel could become the only US-based chip company with advanced manufacturing at scale. In a world where supply chain sovereignty matters, this could be a major long-term advantage. To me, this isn't just a tech story, it's a geopolitical one. That gives Intel a level of strategic relevance that's hard to ignore. Then there's the technology roadmap. Intel is working to regain process leadership by 2025 through its 5 nodes and 4 years plan. They've already launched Intel 7 and are pushing toward Intel 3 and Intel 20A. These smaller nodes increase performance while lowering power usage, and they're critical for competing in AI, cloud, and mobile computing. At the same time, Intel's Go the AI chips are being positioned as an alternative to NVIDIA's GPUs in data centers. This may not dethrone NVIDIA tomorrow, but having a credible second option is already getting attention from hyperscalers. Again, this is long-term strategic thinking that I like to see. Of course, there are risks. Intel's turnaround depends on execution. Any delays in fab construction or yield optimization could hurt margins. Competition from AMD and TSMC remains fierce. Also, AI workloads are currently dominated by NVIDIA, and even Intel's bullish Go the push will take time to scale. But the company has been through tough cycles before, and it has the balance sheet and institutional experience to survive and rebuild. I'm betting on that strength and legacy. In conclusion, Intel isn't the company it was 5 years ago, and that's a good thing. It's not the dominant player it once was in PC chips, but it's fighting to lead in AI infrastructure, foundry services, and national security critical semiconductor manufacturing. Its fundamentals are compressed now, but that just enhances the potential for value expansion. The balance sheet is sound, the strategic pivot is underway, and the global importance of what Intel does only continues to grow. For me, this is a classic case of short-term pain for long-term gain. Intel may not excite growth chasers, but for long-term investors looking for value, stability, and a potentially massive rebound, this stock is one worth watching closely. It's a deep value tech play with the tools and ambition to make a serious comeback. And if they execute even 70% of their roadmap, I think the market will reward that execution handsomely. I know I'll be here to watch it play out.